Alex, welcome to Questioning the Manager. Let's start with America, seems to be on everyone's mind. Since the election, there's been a lot of expectation on Trump's ability to quickly push through fiscal policy. That now seems to be faltering. How are markets reacting to that globally?
Well, starting, I suppose, in the US, the companies with very high tax rates perform stunningly well, and domestic players on the back of Trump, as you say, sort of trying to fire the domestic economy, cutting taxes. And those things have really struggled to be enacted and follow through. And we've seen those sort of cohorts of stocks actually come back to levels they were almost at the start of November last year. So I think a lot of the hype has come out of stocks, and we're back to looking at fundamentals, which is good news. So we're looking at whether the economy is driving forward, how companies' profitability is expanding. Outside the US, I don't think there was a huge reaction internationally to stocks in that sense. Again, when you look at behaviour in Asia or Europe, I think it's more about what's going on in the economies and locations there rather than a US effect. But ultimately, we still like the US market. It's expensive. We have made some cuts in some one or two holdings there, but we're still there in a large proportion of the portfolio.
And is that what's driving your reduction in the US weighting? It's nudged down a little bit over the last few months. And your increases in Europe, is it the expensive thing or is it the kind of political thing?
I think it's valuation based. We look at that market, it's not cheap at an aggregate level. You're paying almost a sort of 20-25% premium to own a US stock over an Asian or European sort of equivalent, and to us the fundamentals are okay, but not that strong. And so I think we look at stock by stock, and one or two names we feel have reached their full potential, and everything is in the shop window to some extent on those names. And we've been selling one or two positions and reallocating that capital, both to reducing the gearing in the short term, but as we find more names to buy in Europe and Asia, we should see that money flow into those regions.
What are those things you've been looking at in Europe and Asia? Where has the money been going that's come out of the US?
Well, the obvious case is France, is an easy one to start with. A lot of political uncertainty, a very unusual political race ending up in two players effectively in a runoff. And I think in that sense, a lot of uncertainty in that market, cheap valuations, still a great place for a lot of reform, and hopefully we can see some resolutions to that election process and fundamentals look okay. Outside that, again, more Northern Europe still we favour the Scandi markets, Germany, the Benelux markets, where again we see very low unemployment, so good amount of wages being reinvested, wage growth is growing nice and strongly, and so whether that's financials or domestic spending opportunities, we like those sort of areas, I think, within Europe.
Japan is a reasonably large weighting in the portfolio overall. What's your rationale behind that?
Well, I think Japan is back to some very interesting stocks within that market. It would be wrong to ignore the whole market. We understand the demographics are difficult, aging population, very low inflation, almost disinflationary economy. So there are certain areas of the market that you don't go looking for opportunities, but that means there are still some very world-class quality companies in Japan. And the digital sort of transition of the economy as well is throwing up some very interesting opportunities there as well. So we like certain plays in, whether it's the auto sector, exporting internationally. We own an online recruiter there, for instance, and so one or two opportunities. The market as a whole, though, is still very, very well priced. Corporate behaviour, we think, is improving in Japan. Used to be a market where companies sort of gold-plated everything to the extent, so very low returns on equities and assets within businesses. That is changing. We're finding much more sort of Western thinking in the sense of the return on cutting assets within the companies, increasing return on equity, therefore, and profitability goes up, and that should drag share prices as well.
Finally, income is very important to investors in bankers. You recently celebrated your 50th anniversary of increasing the dividend. What's the outlook for income for the portfolio given the backdrop we've just talked about?
Well, with the annual results that we announced in January, the board issued a statement saying they forecast a minimum 5.8% increase in this year's annual dividend, and we're comfortably on track for that. I think cutting US is a low yielding market. Actually moving that money into Europe is a relatively high yielding market, as is Asia. So you can see there that's probably an income enhancement opportunity. The challenge on the other side, though, is probably exchange rates, and particularly sterling. We pay a sterling dividend in pence and pennies per share, but actually a lot of our assets are now international. So sterling strengthening will have a minor impact on our income, but actually at the bottom up, at the corporate level, we're still seeing very good dividend growth coming through. If anything, it's accelerating a little bit from a sort of low point in 2016. So actually, company by company, we're very comfortable with the income being generated within the portfolio.
Alex, thank you very much.
Thank you.